Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Global equity markets rally after Donald Trump's decisive victory in the US presidential election. Kamala Harris concedes, promising to help with a smooth transition. Markets will turn their attention to the Fed and the Bank of England. Both look set to cut rates today. We'll also bring you the Riksbank decision. Plus, Chancellor Olaf Scholz calls for a snap election and fires his finance minister, Christian Lindner, as his coalition collapses over government borrowing plans.
In the meantime, a quick check on these markets. And a guy green on the screen in the equity market and the currency market. A little bit of a reversal of what we saw in Europe at yesterday's opening trade. Euro Stoxx 50 futures higher by about 0.5%. The FTSE 100 about the same margin. But the strength in the euro and the pound is really where you want to keep an eye. Given that dollar surge yesterday, some of those bets getting pared back. Countdown to the opening trade starts right now.
We now have a new investment regime, most likely for the next 4 years.
So markets are reacting in an incredibly rational fashion.
You can actually commit to some of those trades.
Some of the knee-jerk reactions that we are seeing may get reevaluated.
I think it could be small caps that end up correcting here.
What does this mean for the places I want to be in the equity markets? And that's why you go to small caps. That's why you go to regionals. That's why you actually probably put together a basket of stocks that has a high percentage of domestic revenue.
Yesterday was pretty phenomenal in terms of the Trump trade and what we saw on our screens in front of us. Good morning, folks. Welcome. Today is going to be no different. There is so much going on. We have so much to talk about. You've got a political crisis in Germany. The Bank of England press conference is going to be must-watch viewing. The Fed press conference a little bit later is going to be must-watch viewing. They've both got really tricky questions to deal with. Now we're into the Trump 2.0 agenda. Then, of course, we've got to factor in what is happening around the world from a different perspective as well. We've got all kinds of things to factor in when it comes to the markets, and other central banks are going to be on the agenda too. Kriti, we are buckling up for a bumpy day. Germany's interesting. You've got markets being interesting. You've got press conferences from the Fed and the Bank of England. It's going to be a busy day, but Trump is at the center of all of this story still.
He absolutely is. It feels like he's almost mobilizing some decision-making throughout Europe and arguably Asia as well. We'll circle back to the international reaction, but this is traditionally where we enter kind of that lame duck period, where 2 months between the election and the inauguration tend to be fairly calm. Nothing really happens in Washington. This might be the exception to that, in that every comment is going to be heavily watched. I think what's crucial here, though, for an international audience is that at the very beginning, given he just got elected, the initial comments, the initial reaction may be more domestically focused and internationally focused. So instead of looking at things like foreign policy, maybe looking at things like immigration, tax cuts, et cetera, and the policy lens that you look or view Trump is not necessarily defense, et cetera, or tariffs. It may be the impact on the Fed.
Right. And in terms of that domestic agenda, we still wait to see what happens in the House, because that could be one check on his movements to the extent that is possible on certain issues. And that could have a policy impact, even on the Fed, perhaps. In terms of the global impact, though, Kriti, that was writ large in markets yesterday. I mean, people are talking about whether the euro goes to parity now. We saw all of the assets in focus that you mentioned, both in the United States and globally. European stocks losing their footing as the markets go, yeah, sure, there might be lots of growth in America, and that might be good, but hey, hang on, tariffs and what that does to the European economy.
Is this the crisis Europe needs, though? Is this the crisis that finally crystallises the idea that Europe needs to get on with it? I think that's going to be a really interesting conversation that we need to theme throughout this show. And I think it's going to be one that I think Germany plays a part in, and I think also one that we've got an EPC meeting today that is going to be really interesting to hear what European leaders have to say. Yes,
absolutely, and galvanising people on defence spending, for one thing. Let's go to Germany, shall we? Because we've seen Christian Lindner fired. Germany without a finance minister. It's seemingly because of a difference of opinion around borrowing rules in Germany and how much fiscal stimulus should be put into the German economy. Scholz saying that more financial wiggle room is needed. The economy is stagnating. Companies need support now. And to your point, Kriti, earlier, you wonder how much Trump coming into the White House once again, trade wars in the offing, whether that crystallised some conversations that have been sort of running beneath the surface in Germany for a very long time and now very much blowing out into the open.
Well, I think a great example of that economic weakness that they're trying to address is the data we got just 3 minutes ago. This idea that September industrial production in Germany has fallen 4.6% on a year-over-year basis. The estimate was 3%. Every data point we get out of Germany sends that same message, which is the economy isn't getting any better, it's only worsening.
Jens Larsen's going to be joining us very soon to talk about all of this from Eurasia. I caught up with him just a few minutes ago, and I have to say it's really interesting that we are starting to see, though, a line emerging, and I'm hearing this from a number of different places, that Europe now has to deal with this crisis that is Trump. And the fact that we've actually got a situation emerging where Germany actually maybe bringing forward its elections could be perceived as a good thing. You could actually finally start to see Europe galvanizing itself into action. I think that's going to be hugely important. The central bank story is going to be really important in all of this as well. How far can the European Central Bank go in terms of cutting rates to support the German economy with a Fed that may be in a very different position? It is going to be a fascinating press conference later on from Powell. Bailey's got a lot to deal with as well. Trump wants in on the action as well, and that's going to be a huge challenge for the Fed to deal with. So today's press conference is going to be huge. I'm genuinely quite excited. I'm usually excited.
Do you have your popcorn ready?
I do. I think it's going to be one of the best ones we're ever going to see. And I think it's going to be a series of questions that we're not going to want answers to. Valerie Teitel is standing by to give us an assessment of the Powell challenges. Val, I've got my popcorn ready. I'm assuming you have as well.
Yes, I do. Powell is going to be facing many tough questions today, and we're going to be on tetherhooks for any hints about what he thinks could be the economic impact of this change in policy in Washington. These are 4 topics that I'm going to have my eye on when it comes to the Q&A. The biggest one is tariffs. Is he more worried about the inflationary impulse from tariffs, or is he more worried about the downside hit to growth that they could entail? And then we flip over to tax cuts. Is he more worried about that boosting Treasury supply to cover this growing fiscal deficit, or is he more focused on the upside risk to growth that cutting corporate taxes could entail? Next, the deportation of migrants. Is that going to cause a tightening of the labor market and maybe see a resurgence in wage inflation, which could ignite sticky services inflation again? And then lastly, energy policy. Drill, baby, drill. Oil down to $40. Trump told us he wants to get it there. Is that going to be a deflationary impulse, or is it going to be a pro-growth impulse? All of these questions are going to be on the market's minds as Powell takes the stand tonight. But let's not forget, we also have the Bank of England. And in some way, they're dealing with a very similar thing, a change of government and change of policy. But we've also already gotten the UK budget, and we've already seen the market's reaction to it. What is the Bank of England going to react to it when it comes to their growth and inflation forecast that we get today? We've already seen the OBR's projection for higher inflation, especially when it comes to next year. They revised it up 0.4 to 2.6% post-budget. Do we see that match today in the Bank of England forecast, or are they more worried about it's just a temporary boost to growth and we're not too worried about a temporary boost to inflation? We're going to see through it and continue our easing cycle.
Val, thanks very much indeed. Valerie, talking about the Fed, talking about the Bank of England. How far can European central banks and the US central bank diverge? If the Fed doesn't go as far, and the market's pricing this now as we had originally anticipated, how much cutting can we see from the ECB, from the Bank of England, even if they have a deflationary environment that is different to what we see in the United States? It's going to be a really difficult question. The market was trying to price that yesterday.
Yeah, and what does it do to their transmission, their ability to transmit their policy through their economies if we see this this flow of monetary policy across the Atlantic? So if we see slightly higher rates than we'd anticipated in the United States, how does that crimp the ability of central banks in Europe to reduce interest rates? That didn't seem to be the story yesterday. We got some quite substantial moves in bond markets. And, of course, we add into that, we'll be looking for the reaction to the German story a little bit later.
Yeah, and on the surface, you would think that's a fairly easy trade, right? Especially in the FX market, you see parity potentially on the table, more weakness in the bond story as well. And yet, Eurodollar's at a 107 handle. And I'm curious if that's the dislocation maybe that a lot of the FX and rate strategists and investors are going to be capitalizing on.
It's going to be amazing to watch how the impact is felt and how far central banks can go. Europe and the United States potentially on very different pages at the moment. We've got some great guests lined up to talk about all of this. Robert Hart from Maastricht University talking transatlantic relations, Trump 2.0. We'll talk about that. SocGen's Phoenix Kalen's going to be joining us, unpacking the Trump trade. Did you see the big moves we saw yesterday in Central and Eastern Europe? Talk about Poland, talk about the Czech Republic. All of these kinds of countries have seen a significant impact. Svelland Capital's Nadia Martin-Wiggen is going to be joining us to talk on Commodities story as well. Drill, baby, drill was the story from Trump, has been the story. Will it be the story from Trump? And is this the end of the green revolution in the United States. Is this anti-renewables, Kriti, I think is a key question as well. Certainly seemed to be yesterday in the market.
Well, I don't know. So many of these kind of big oil companies in the U.S. and around the world have actually pivoted to take on more of those green emissions, take on more of those climate goals. Now to roll that back, maybe Trump doesn't have the support that maybe he once did. There are a couple of other things to watch, though, on the agenda as well, because it is central bank palooza today. At 9 a.m., we do get the Norges Bank decision. And then just 3 hours later, of course, it is the BOE decision and presser just 30 minutes after that. Some data as well kind of punctuating the day. At 1:30 p.m., U.S. initial jobless claims are going to hit. And then the big Fed decision, of course, at 7 p.m. UK time, 30 minutes later, followed by that popcorn eating event, as Guy put. But then politics also on the agenda, the European Political Community Summit beginning in Budapest.
Yeah, really important this. And a Draghi is in attendance, apparently, because they wanted to be talking about competitiveness. You feel like maybe some of the recent political events, certainly in the United States and certainly in Germany, might dominate slightly.
You have to feel that this has got to be some sort of a catalyst for Europe. If there isn't a bigger catalyst, I don't know what it is. We've seen a war that's given us some sort of a catalyst here in Europe. We've seen a political stagnation story. We've seen an economic stagnation story. That doesn't seem to be is Trump 2.0 finally the crisis that Europe needs to get its act together and to stand on its own 2 feet? I think there'll be.
I might just have to wait a little bit longer, though, for Germany to get this done, because this doesn't actually happen until January, March, does it?
No, but at least that's earlier. At least that's earlier than maybe it could have been, which would have been October, which you could see as a positive. What else do you need to know this morning? There's a few other things going on. Ireland's Prime Minister has called a snap election on November the 29th. Seems to be a theme at the moment. Opinion polls show slumping support for the main opposition party, Sinn Féin. Simon Harris took over as leader as the governing coalition's main party back in April, promising fresh ideas on issues including immigration. China's export growth has surged in October at its fastest pace since July 2022. Check out your screens right now. Take a look at what is happening with Chinese markets right now. Exports rising from a year earlier to $309 billion, significantly exceeding any economist's forecast. Imports, though, fell 2.3%, leaving the third highest monthly trade surplus on record. I'm sure Donald Trump will be paying attention to that. And Qualcomm shares have surged in late trading after the company gave a bullish sales forecast. The company says revenue in the December quarter could reach over $11 billion ahead of forecast, signaling a rebound, potentially, for the smartphone market. Staying in that space, ARM shares, meanwhile, slipping after the bell on a disappointing outlook. The UK-based chip designer sees revenues between $920 and $970 million in the third quarter. Is a Trump presidency good news for big tech? Big tech has been sort of crimped in its ability to do deals, to expand, to kind of get round regulation. Does that change in a Trump presidency?
I don't know. The bipartisan kind of scrutiny on tech is really tough. And both Trump and Harris and Biden have all kind of made that comment as well. So I don't know if that eases up necessarily. I thought it was interesting on the ARM and Qualcomm story. There is a hearing. There's a trial coming up between both of them where ARM has accused Qualcomm of using their intellectual property without their permission. So they're both saying different things in terms of the smartphone market. Qualcomm, of course, also trying to diversify.
Yeah, that one currently in court, of course. I'm really interested in the role that Elon Musk is going to play in all of this. I mean, is this going to be the power behind the throne when it comes certainly to the tech sector and perhaps beyond? What does it mean for Tesla? What does it mean for SpaceX? What does it mean for AI as well? Because certain members of Trump's team have threatened to rip up an executive order putting ring fencing and barriers around safety and AI. So certainly a lot to talk about there. We have tried to do some of it justice in the first part of the programme, but there's plenty more in the programme. Coming up, we'll be heading to Budapest, where European leaders are meeting to discuss Ukraine and much more. That's the wider EPC and then the the European Union leaders meeting later. Plus, we'll break the Riksbank decision. That's coming the start of a big day for central banks, expecting a big cut there. Up next, politics and markets collide. Again, we discuss the post-election Fed cut and Germany's fractured coalition. If you have any questions for our guests, then please get involved in our conversations. We really want to hear from you. Trump 2.0 is about to get underway come January. We have a lot to discuss. IB plus BBTV Go. That is the function to use on the Bloomberg terminal. This is Bloomberg.
Olaf Scholz has long failed to recognize the need for a new economic awakening in our country. He has long played down the economic concerns of our citizens, Even now, he's questioning the necessary decisions so that citizens can be proud of Germany again.
Christian Lindner, the leader of the FDP and Germany's former finance minister, speaking after being fired by the German Chancellor Olaf Scholz. The news of the collapse of the ruling coalition plunging Berlin into a political crisis just as Europe comes to terms with the second Trump presidency. With us now, Jens Larsen, Director of Global Macro Geoeconomics at the Eurasia Group. Is it a good thing that the German coalition has collapsed?
I think it's a good thing in the sense that it brings about a crystallization of that political risk that we've seen in Germany. So it'll bring resolution to the German political crisis sooner than it would have if they'd stuck to the election schedule, which was for October next year. So we'll get some clarity, and Germany may be able to act. It's not going to happen tomorrow, but it'll happen sooner than it otherwise would have.
So if they do get rid of this kind of limit around their issuance, where does that spending go? Where is that concentrated?
There's certainly priorities on defense. They've already set resources aside for that. But I think what Germany really needs is an industrial strategy backed up by Germans' fiscal resources that addresses the issues that they have in the German industrial sector, that addresses the issues of productivity, but also, I think, a much more proactive European agenda that where you see Germany exerting leadership, both because of the strategic challenges Europe are facing, but also because of the economic challenges Europe are facing. There's a huge need for investment identified in the Draghi report, and Germany needs to play a leading role in terms of providing the resources, but also building momentum at the European level.
So, Jens, we heard from Olaf Scholz yesterday saying that more financial wiggle room is needed, the economy is stagnating, companies need support now. From what you're saying, there are things domestically to spend that money on that would help. It isn't all about Chinese demand or about over-reliance on Russian cheap energy in the past. There are things domestically that this money can put to work on.
Absolutely. Germany has underinvested in the last few years, has oversaved and underinvested, and it's relatively straightforward for macroeconomists to say what they need to do. It's harder for them to implement, and I think their opinion is that it's hard to spend the resources in an economy that's really struggling with the tight labour market. But the resources are there. This is not a fiscal issue. This is a matter of focus and of strengthening the domestic economy.
Germany needs to rearm. That takes us to the Ukraine question. If Trump could deliver, and this is all under the sort of Trump umbrella now, if Trump could deliver peace in Ukraine, how big an impact would that have on Europe, the European economy, Europe's ability to move forward at this stage?
So it doesn't free up an awful lot of resources immediately, but I think it would mean that you have a different policy focus. You could focus on other elements of the strategic agenda. You could, and I think importantly, think about how you are going to embed Ukraine in a political structure in Europe to secure Ukraine's future. And you could think about that necessary expansion of the EU. At the moment, governments, well, the German government is focused on the likely upcoming elections. In France, you have a political crisis. They're not thinking long term. They're not thinking about how to manage that situation with Ukraine by the time things start settling. And I think if we can free up capacity to that, I think politically that would be a big deal. But it would also give them more space to think about the very significant economic challenges.
OK, some big political challenges then, and that takes us to the economics, Jens. Stay with us, of course. Jens Larsen from Eurasia Group. And let's pivot to the impact of the Trump win on global central banks. Bloomberg's UK correspondent Lizzie Burden is at the Bank of England, where a rate decision is due today, Lizzie, and, of course, coping with the budget that is homegrown, but coping with a new resident of the White House from January next year.
Yes, Anna. All of the economists in our survey expect a quarter-point cut today, so the focus is on the path ahead. As you say, the budget throwing a spanner in the works. Ever since Rachel Reeves sat down from her speech, you saw the gilt market reaction because this is the biggest fiscal loosening in decades. So the expectation from traders was that it would slow rate cuts from the Bank of England. Then, however, we got the Trump win. That expected to weigh on European growth via tariffs. And so as soon as he was announcing his victory, you saw markets changing their bets for the BOE and the ECB again. Interesting to look at the currency impact. So you saw the pound gaining against the euro but falling against the dollar, suggesting that the market thinks the hit to the UK will be less than to the Eurozone. But also JP Morgan Asset Management's Karen Ward saying that if there's a fiscal response to Trump's tariffs, then actually that could be inflationary, and actually that could throw into the mix on the Bank of England's rate path ahead. So really interesting today to look at the updated forecast for inflation and growth. It's too late to factor in the US election, but we'll see how they're thinking about the budget, and therefore even more focus on what Andrew Bailey, the governor, says today. He's talked about a more aggressive path ahead recently. He's in conflict with his chief economist, Hugh Pill, who's been a bit more cautious. But markets currently expecting a 1 in 4 chance of a December cut and 3 cuts fully priced for next year. Let's see how that changes, Guy.
Yep. We're going to keep a firm eye on this press conference a little bit later on today. UK correspondent Lizzie Burden outside the Bank of England. Thank you very much indeed. Of course, then we move on to the Fed, another central bank that is firmly in the spotlight post the US election. That result very much in focus. The Fed deciding today, the announcement at 7 p.m. UK time, 2 p.m. Eastern. This is what incoming President Trump had to say about his role in setting interest rates in a conversation with Bloomberg's editor-in-chief, John Micklethwaite, back on October the 15th.
I think I have the right to say, as a very good businessman and somebody that's used a lot of sense, I think I have the right to say that, you know, I think I'm better than he would be. I think I'm better than most people would be in that position. I think I have the right to say I think you should go up or down a little bit.
Donald Trump in conversation with Bloomberg's editor-in-chief, John Micklethwaite, last month. Jens Larsen still with us around the table. Is Powell going to have a Trump problem?
I think Powell has a big Trump challenge, let's call it that. So the economic policy agenda that you outlined earlier with tariffs, fiscal, migration policies that are all, I think, pointing to a much more inflationary outlook. It's a big negative productivity shock. It's exactly the sort of thing that central banks don't like dealing with, particularly in an environment where inflation has been really high. So that in and of itself is a big challenge. If they need to respond to these inflationary pressures, having the president shouting at you is probably not a good thing. So I think this is a cause of policy uncertainty. This is a source of uncertainty about inflation, higher inflation risk premium. So an undecided state of affairs.
We have a little bit of a roadmap here, though, don't we? In terms of in March of 2019, Powell and the Fed cut, not because the economy needed it, but it was an insurance cut against the trade war that had erupted with China under the Trump administration. Do we see that happen again? Are insurance cuts on the agenda, not just in the U.S., but globally?
I don't think so. And I think the important thing to hold on to here is this is a negative supply shock. The combination of his agenda, the impact on global trade means that this is a more inflationary environment for central banks globally, and that is going to restrain them rather than encouraging them. Yes, there's less growth, but given the inflation experience we've had now, and we hadn't had that experience in 2019, that was a much more deflationary environment than we are in now. In this environment where we've had this inflation shock, central banks are going to be on the toes when they see supply shock. So I think when you're thinking of the Bank of England today, absolutely right. These are critical decisions. Of course, Andrew Bailey can't comment on policies that haven't been enacted. When you're thinking of the environment, when they're thinking about these scenarios they want to consider, one of them ought to be a scenario in which inflationary pressures are more persistent. And that is what Trump's policies mean. There's more persistent inflationary pressures.
And just briefly, Jens, could the direction that the House goes in have an impact on just how inflationary?
For sure.
Because we still don't know that.
Absolutely. And I think if it is a clean sweep, then I think there will be more tailwinds for these inflationary policies and more pressure on the Fed.
OK, Jens, thank you very much. Thanks so much for joining us, taking us around the world in some of the political challenges that central banks globally are having to deal with. Jens Larsen, Director of Global Macro Geoeconomics at Eurasia Group. Coming up, we will stick with some of the politics and how it plays out across Europe. What does Donald Trump's election mean for the future of Ukraine? We'll get the latest live from Hungary, where European leaders are meeting. This is the wide group meeting, more than 40 leaders, I think, meeting at the European political community level. These meetings come ahead of an EU leaders summit, which is on Friday. Lots to talk about when it comes to European competitiveness and, of course, Ukraine. This is Bloomberg. Welcome back to the programme, everybody. This is the opening trade here in Europe. 30 minutes to go until we see this opening trade. Let's have a look at the futures picture, and it does look mildly positive. I say that because of the extent of the of some of the selling that we saw across Europe yesterday. I mean, the stock 600 was only down 0.5% by the close, but we did see some weakness after initial euphoria around the growth agenda that even made its way over to Europe. Then by the end of the day, we focused more on tariffs, perhaps, and we saw some selling. We are expecting then a little bit of a bounce, perhaps. Autos and parts, utilities were all under pressure yesterday for reasons that are very linked to tariffs and US energy policy. This is the bond market picture. Really important to keep an eye on this, in particular what's going on in Germany, and not actually seeing a huge amount of movement. We see 2.4142 on the German 10-year yield. Not a huge amount of movement, despite the fact that we are witnessing the collapse of the German government. We've seen the finance minister fired and Olaf Scholz, the Chancellor, calling for new elections. Of course, that can't happen and isn't in his gift, but it will, it seems, probably happen at the beginning of next year sometime. That's the German sort of political chaos then in the mix. Let's get over to Bloomberg's Oliver Crook, who joins us now from Budapest, where leaders from the European political community are meeting. So much for them to discuss then, Ollie. There seem to be mixed feelings then among European leaders about Trump's presidency. Some of them set to lose, some perhaps set to win. What can we expect from the meeting today?
Yeah, that's right, Anna. And just to explain sort of where we are, we're in Puskás Arena, which is where Viktor Orban has decided to chair this meeting here in Budapest of the European political community. And this is really a sort of summit that is a very wide summit. It includes many European leaders from across the continent, one of the widest forums that we have. And it's really a sort of summit that was devised by Emmanuel Macron in response to Ukraine. And Ukraine is going to be at the center of the conversation here for European leaders. Of course, that outcome from the U.S. election has absolutely seismic ramifications for Europe on a number of different levels, but perhaps for nobody more than Volodymyr Zelensky. Of course, we've heard from Trump repeatedly. He said that he will have the war ended within 24 hours of winning the election. We're close to 24 hours after he's been declared the winner. And the question for European leaders here is, if he comes to Ukraine, he speaks to Putin, he comes with some kind of deal, how do they respond to that? How do they play that? And that is exactly what I asked the Estonian Prime Minister, of course, a frontline NATO nation, about the sort of situation in Ukraine and how Europe should respond. Have a listen to what he had to say.
If you allow Russia to change borders by force, and they're saying, yeah, we will give half of your country to your back, so it's not acceptable, I would say, to Europe. It probably will be a stigmata for a long time.
But the fundamental question is Europe able to go at it alone? And I think for European leaders here who are having these discussions about the Trump administration part two for the very first time, there is this question. For Donald Trump, we know that what Donald Trump needs to be taken seriously. Does everything need to be taken literally? This will be the question on Ukraine. This will be the question on trade. And if we are to believe what he says about 10%, 20% tariffs and withdrawing support from NATO, how will these Europeans sort of respond in a collective and sort of a unified way?
Well, is that the trick to that kind of collective, unified way? I mean, it feels like decades where that's just been the struggle. Is this the crisis that will ultimately bring Europe closer together?
Kriti, I think that is precisely the question before the leaders here, and I think that is the way that many of the leaders will sort of try to put a positive spin on the election, many of whom are obviously dismayed, frankly, by the outcome of the election. Not all of them, but many. And of course, it may bring people closer together. It may blow people apart. Let's not forget where we're standing right now in Hungary and Budapest. They own the sort of presidency of the European Council right now. Viktor Orban's tagline for that is "Make Europe Great Again." Impossible to sort of misinterpret what he means by that. There's a question about whether he will have Donald Trump sort of piped in here via video to talk to leaders. That might, ruffle a few feathers. But really the question is, can this bring Europe back together? The Estonian Prime Minister, again, who I spoke to last night, says that this is the moment where you have that wake-up call. Have a listen.
Person is not the best one, but usually when a person gets a little bit older and gains a little bit in kilograms, wake-up call comes suddenly. And after that, you will work out and get fit and so on. But Europe is the same. You get fitter, and it's not a bad thing for Europe.
So him likening Europe right now to someone that is old and out of shape, and that basically Trump is going to be the instigator to get him back in shape potentially under coach Mario Draghi. But to sort of complete the metaphor and take it to its absolute limit, you have the two sort of best players here on Team Europe, France and Germany, both in exceedingly weak positions. There's some real doubt whether or not there's going to be able to get everybody on the same page and make those very difficult political and fiscal decisions to move Europe forward.
Bloomberg's Oliver Crook reporting from Budapest today, of course, where some of those world leaders are meeting right on the heels of that U.S. presidential election. We thank you so much. And that's where we want to continue the conversation. EU officials, of course, preparing for a changed relationship with the United States as Donald Trump's victory brings with it the threat of more protectionism. I'm pleased to say we're joined this morning by Roberta Haar, professor of foreign policy analysis and transatlantic relations at Maastricht University. Roberta, a pleasure to see you on the program again. Let's pick up where Ollie left off. This idea of Trump being the unifying factor. Are we already seeing elements of that in the news out of Germany overnight? Is Trump the crisis Europe needs to get their act together?
Yes, well, good morning. Yes, thank you for having me. And very interesting conversations that I saw prior to mine. Indeed, that is one of the dilemmas. What sort of impact will the Trump presidency have on Europe? And it might lead to cohesion. That would be the positive outcome, but it might also lead to fragmentation. There are certainly some countries within Europe who have, like Viktor Orban in Hungary and Slovakia, where there's much more of a stronger relationship towards or affiliation with Make America Great or Make Great Again. I think that it could be fragmentation could also be the result rather than cohesion.
In terms of that cohesion, though, or fragmentation, Roberta, talk to us about what kind of levers the EU actually has to pull here. If we're talking about tariffs being on the agenda or pulled kind of defense aid either to NATO or to Ukraine, what does Europe have in its back pocket to respond with?
Well, I mean, one of the questions that came up before is, can Europe on its own defend itself? And the simple answer is no. And the serious issue is that there will be a security gap, even if if you can turn to Eurobonds, if you can turn to other ways of financing what needs to be spent in the near future on European security and defense for any sort of autonomy seems to be sort of very far in the future. But if they want to have any kind of self-defense, the security gap will be could be decades, certainly hundreds of billions of spending. What they have in their favor, diplomats. I think Mark Rutte is could have a lot of leverage, has in the past worked very well with President Trump. So they will have to use their soft skills, their soft power, their diplomacy. These are the sorts of things that they will have that could help them in future discussions.
Roberta, good morning. It's Guy. The security umbrella that the United States provides for Europe gives Donald Trump significant leverage over Europe in not just the security arena, but in other arenas as well, such as trade. How far would Europe have to go to level the playing field in order to negate some of that influence? How long could it take?
That's really hard for me to say. But there will be lots of pressures for Europe to maybe go new out-of-area expectations for their defense. Trump may ask them to align along with U.S. pressures in the U.S.-China strategic rivalry. This is going to be a dilemma for Europe. How will they balance their own economic interests against what Trump will want in the U.S.-China rivalry? You talked about the Fed, so inflationary pressures. Where will Europe fall when Trump tries to take away the independence of the Federal Reserve and Jerome Powell? I think these are all dilemmas and challenges that will be very clear in the next few days or weeks. Well, he won't, of course, come into office until January. But these are things that Europe is going to have to work out, and they will have to dig deep to. And it could be, indeed, the crisis that brings them together. Although in the current world, the way it's going, multilateralism is very much under threat. And of course, multilateralism is what the European Union stands for. And all these things put a lot of pressure on multilateralism.
In terms of what a peace or a stalemate or whatever it ultimately looks like in Ukraine could do to the European story, what do you think it would look like? If Trump can deliver on his promise to deliver peace in Ukraine, what impact would that have?
Well, your previous speaker said that would be devastating to give away territory to Russia. I mean, I think that Trump that he can resolve that in one day. That seems very fanciful. I mean, what tools does he have? Does he think that he can call up Putin and resolve it? I think I think this is a very challenging issue and one that will affect European security, especially in the Baltics, which Putin has also had sort of very avarice thinking about. The Baltics are very vulnerable, I think, if Trump thinks that he's going to give territory away to resolve the issue as quickly as he thinks that he can.
Roberto, where does this leave NATO? There was lots of talk about NATO disappearing under the first Trump presidency. It didn't. It was certainly put under a lot of pressure for spending to come from places other than the United States and some European countries. But where does NATO go? Does it withstand Trump 2.0? Is it furloughed in some way?
Well, there are many implications for what happens to NATO. Certainly, there will be more pressure on Europeans to increase their defense spending. There will be certainly a very strong possibility of retrenchment on the part of the part of the United States. Trump has said that, I mean, in the last administration, the U.S. Congress tried to Trump-proof NATO and pass a law that the U.S. can't leave it. But as commander-in-chief, Trump could do many things to undermine the operational presence, maybe NATO-led exercises, initiatives. And as I said before, it could create a very strong security gap as the U.S. pulls back. Also, strategic cohesion, as I already mentioned, certainly the rising tensions within NATO, different priorities, operational responsibilities, potentially reducing NATO's credibility, particularly against Russia. I think those things are very impactful. Also, I mentioned this out-of-area possibility. I think that the U.S. strategic rivalry definitely will mean that Europe might have to align more with the U.S. There might be demand by the Trump administration to have this less of a traditional focus on Europe, more of a consensus that it has to look towards Asia. So there could be very strong implications for NATO in the future. And it will face a lot of different dilemmas of how to go forward.
Roberto, thank you very much. Roberto Hart, Professor of Foreign Policy Analysis and Transatlantic Relations at Maastricht University. Thank you very much for joining us. There's a lot to factor into the programme this morning. We're keeping an eye on German politics. We'll get to that in the next part of the programme. Also coming up, activist investor Elliott Investment Management is said to have built up a sizable stake in the German utility RWE. The story is a little confused around what exactly is going on here, but we could see some movement in the stock regardless. We'll get a focus on that stock next. That's coming up. This is Bloomberg.
Breaking news over the last couple of minutes. We have a new German finance minister, the German State Secretary, Jörg Kukies, to become the new finance minister after Christian Lindner was fired by Olaf Scholz yesterday, basically collapsing the German coalition. Let's talk about the implications of all of this. We are also waiting for the German opposition leader, Friedrich Merz, of the CDU-CSU, the Conservative bloc, which could potentially form the next German government at the beginning of next year. You're looking at a very exciting live shot in advance of that conversation. But I want to go to Berlin right now and talk a little bit about what is happening and what is going on in terms of the breakdown of this fractious coalition and also what we know about the new German finance minister. Let's go there now and talk to our Europe executive editor, Chad Thomas. Chad, I just want to start with Jörg Kukies. What do we know about him? He works for Olaf Scholz. He's not from the FDP. The coalition has broken down. All of the ministers have been withdrawn. Just talk us through the implications of this for Germany in the near term and what this new finance minister is going to hope to achieve.
Yeah, Guy, this is unfolding very quickly. So first, starting with Jörg Kukies. So he is someone who has worked very closely with Olaf Scholz for many, many years. When Olaf Scholz was the finance minister under Merkel, Jörg Kukies was already working with him. Kukies is a former banker, and he has been Scholz's chief financial advisor, economic advisor within the Chancellery. So obviously Scholz decided to name someone as finance minister with whom he works very closely after this very fractious relationship that he has had with Christian Lindner over the last 3 years in government. We also just had the German transport minister. He is a member of the FDP. His name is Volker Wissing. He has said he's quitting the FDP to remain in the government with Olaf Scholz. So it looks like the FDP is also starting to unravel this morning. Meantime, we're waiting for a press conference from Friedrich Merz. He is the leader of the German opposition party. This is the party of former Chancellor Merkel. We're hearing he's likely to call for this snap vote. Right now, they're saying that this snap vote would happen probably in March. He's likely to call for that to happen much more quickly. All of this is up to the German president to decide on. So as we watch what's happening today, it's unfolding very quickly in Germany. This all coming to a head last night here in Berlin.
And of course, we do have those live pictures of Chad as we speak of that press conference. And you can see that, of course, on your screen here. But Chad, walk us through what this means for Germany in the coming months. What does the timeline look like in terms of snap elections, in terms of confidence votes? Lay it all out for our audience.
Yes, so what will need to happen in the way the system is set up here in Germany is there needs to be first a confidence vote. Right now, Scholz is saying that confidence vote will take place in January, and then a snap election, Kriti, has to happen within 2 months of that confidence vote. So that would mean the snap election would happen in March. But there is already a movement afoot within Germany for this to move much more quickly. Obviously, everyone is watching the timeline also in the U.S. with President-elect Trump set to come into office in January, and there's a desire here among the political elite to get in place a new government to deal with any fallout that might come from President Trump. Of course, in his first administration, Germany was really in the crosshairs when it came to things like looking at tariffs on the German automotive industry and so on. So it's likely that this timeline will be moved up. But right now we're looking at that confidence vote potentially in January and then a snap election in March.
Chad, thank you so much. Thanks for the update. Bloomberg's Europe Executive Editor Chad Thomas, and we'll, of course, bring you live any comments that we get from that press conference that is ongoing in Germany, the CDU and the CSU speaking in Berlin, suggesting that we should have a vote sooner rather than later is one of the lines coming out of that. Let's talk about the markets in 3 minutes. Our Markets Live executive editor, Mark Cudmore, joins us. And Mark, I want to ask you about Germany, not because it's moving markets a huge amount compared to the Trump story, but rather because it isn't, which is quite incredible, isn't it? We see the collapse of the German government, and yet it doesn't cut through what is arguably a bigger economic, well, it is a bigger economic story for the world, of course. We see slight movement in German bunds. We really didn't see much movement in the euro, though, on the back of all of this German news flow.
Yeah, that's absolutely right, Anna. It's had a very little market impact so far. So why is that? One is the story around Germany was already extremely negative. From a market's point of view, this was not a government that was covering itself in glory. So its collapse doesn't really change the situation. It could be seen as positive that we can only probably go a better situation from here, except that's still many months away. And I think it just kind of adds to this idea that, hey, Germany is in a tough place economically, tough place from markets' point of view, and therefore entrenches the narrative that was already in markets. You've got to remember, before this happened yesterday, the euro was the weakest currency, or one of the weakest currencies in the world in the wake of the Trump election, because this idea that Trump's policies, his tariffs, not only will boost the dollar, but they'll be quite damaging for European economy and particularly the German economy. Remember, tariffs are bad for global trade, and the European economy and the German economy is much more dependent on global trade. It's a much more open economy than the US is.
Mark, good morning. It's Guy. Is it time to fade the Trump trade? Are we already talking about that?
Sorry, I didn't hear that. Sorry.
Fade. Is it time to fade the Trump trade?
It is not yet time to fade the Trump trade. I think there are multiple different Trump trades. I think the stocks one can go on for a long while still. As you know, I've been a bull all year. I thought we were going to the last innings. I don't think we're at the last innings of the stocks trade. I think we've got another kind of growth boost that'll on that side. So I think stocks you stick with. I think dollar probably has more to go. I am nervous about that, but I do not know when the timing is. I'm worried by how consensus it is. I'm worried by the assumption that everything Trump will do is dollar positive. I don't think that's right. I think curve steep steepening continues for another month, but you probably don't want it over the Christmas period. Less liquid, especially as people will probably rebalance their portfolios into treasuries before year end because of capital risk ratios. So I think that's got another month, but you probably stop before the end of December. I think crypto doesn't seem to be running with much legs from here. So I think the most sustainable one is probably stocks for now, and I think dollar yen as well.
30 seconds, Mark. What happens to euro dollar? What's the range we're looking at?
I'm hearing a lot of people talk about parity. I think that euro, I stay very, very negative. But I actually think that for 2025, I'd feel more comfortable being bearish euro on the crosses because I think that the dollar component is much more volatile. And at some point, I'm going to want to fade this dollar strength. Not yet sure, but I can't work out whether that's 1 month from now or 3 months from now. So euro dollar, maybe 103 next year.
All right, Bloomberg's Marcus Live executive editor Mark Cudmore giving us all the analysis this morning. Let's go from the macro to the micro. Joe Easton standing by with other stocks to watch. Joe.
Morning, Kriti. So we've got an eye on RWE today. That's after Bloomberg reported last night that Elliott has taken a stake in the company, is potentially going to be looking for a buyback from the renewable energy firm. Now, remember, these stocks were slammed yesterday on the result of the US election. That ADR on RWE actually spiked, completely retraced the entire move on that stock, and potentially we're going to see it rising in Germany as well today. Then in terms of defence and aerospace, we've got a couple of stocks reporting earnings today. Rheinmetall, a big jump in orders over at the German defence firm, and also Rolls-Royce once again powering on with a massive increase in their earnings as well for those two companies. Potentially we're going to get Leonardo as well. Remember, those stocks actually rose yesterday on potential higher defence spending by NATO countries under Trump. Finally, look out for Daimler Truck. This one looking a bit weak, falling on a Tradegate as their earnings miss expectations. That could be the negative one. A very favoured stock buy rate.
Thanks very much. This is Bloomberg.
Thursday morning, good morning. A couple of minutes to go until the opening trade. It's the morning after, really. Yesterday's session feels like a bit of an anomaly. You had the Trump trade on turbocharge, and as a result of which, maybe actually the relationship between Europe and the United States broke down a little bit in terms of the way that it normally functions. So European stocks faded. There's a whole bunch of reasons for that yesterday, but the Trump trade definitely part of that narrative. US stocks, as you can see, up to the moon. Off we went to the races. Does that relationship start to reconnect a little bit today? We're looking like we are going to see maybe futures ticking higher in certain parts of Europe, but clearly not all parts of Europe.
It feels like a tale of two, maybe even three core economies. Let me walk you through it here. The outperformance this morning is actually coming out of Germany and the UK. I'm going to take the UK out for a second, but that German outperformance is something you really want to keep an eye on because it's counterbalancing what you're seeing in France, at least in the futures picture, which are almost pairing some of those losses, but largely risk-off territory, Anna. It's that DAX story that we're really going to keep an eye on at the opening trade.
Yeah, absolutely. And that DAX story being influenced perhaps by the politics, the German opposition leader calling for a confidence vote as soon as next week. We'll keep an eye on the timing of all of these politics developments in Germany. But will that cut through any of the individual stories? We've got plenty of them over in Germany. Let's work from the bottom here, perhaps. Rheinmetall orders surging as Europe boosts its military spending. That stock was actually up by more than 3% in yesterday's session. We're also focused on Daimler Trucks. We've got numbers coming through from that business as well. So that's in focus. The adjusted EBIT beating estimates, which is something to watch. BT in the telecom space here in London, cutting its 2025 revenue forecast. The outlook for its business unit in focus, Guy.
Let's take a look at how these European stocks are going to open. As Kriti says, you may get some divergence within the European story today, which I think is going to be really interesting to watch. There are some single stocks that are focused on as well, but the Trump trade still the dominant theme when it comes to what is happening here. Certainly was yesterday. We're getting a bit more nuanced in terms of our reaction now. Here we go. FTSE 100 higher, the opening trade there. A little hard to call at this point in time. First couple of seconds. The IBEX is open. It's up by 0.3%. Stock 600 in aggregate starting to price this all together up by 0.1%. Just remember that chart I showed you earlier on of where Europe closed and where the US closed. You are not seeing that gap closing in a meaningful way this morning, which I think is really, really interesting, Kriti. Work out what is happening below the surface. I think there's going to be some interesting maybe answers to the question I'm posing there.
It's really something we're going to be keeping a close eye on, guys, especially when we look at this makeup. But right out of the gates, you are seeing a really interesting kind of sector move here. And I'm going to start with the tech space, because one of your biggest index contributions this morning when it comes to the stock 600 is actually SAP. And we are still waiting for some of the other kind of German trades to shake out. So take this with a giant grain of salt. But that is where you are seeing the index contribution, at least early this morning. I'm curious how much of that has to do with some of the numbers we got out of ARM, out of Qualcomm yesterday. Is there a tech theme, despite them being substantially different businesses? You are also, as Anna, seeing a kind of combination of some of the commodities trade there, a little bit of banks. I'm not seeing a clear market read-through. This might be a regional story.
Right, yeah. I mean, the basic resources trade is quite prominent, isn't it? Up by nearly 2% on mining stocks. Is that a global growth story? Is that some optimism around the US economy outweighing nervousness around tariffs? I mean, maybe that's a stretch, but that's where we're seeing a lot of the action this morning. Basic resources on the move higher.
So you've got a strong China story this morning. Chinese equities have been up really quite strongly, so you've got to factor that maybe in.
Yes, but it was export-driven, wasn't it? A lot of that, yeah.
It was, so there was an import story that was weaker, I agree. Yeah. But I think maybe there's a little bit of a Chinese halo effect. What are commodities priced in? Dollars. So maybe that's a factor as well, which is something that could take us back to SAP as well. Huge revenue generation in dollars in the United States as well. I wonder whether that's just a revenue translation story as well, that tech could do better in this kind of environment as well, maybe as a little kicker as well into that narrative too. SAP's had its challenges recently, but I think it's interesting that you are seeing the commodity stocks doing as well as they are. BP, you've got Rio Tinto, Glencore, all trading higher this morning. SAP, big dollar earner, also tracking a little bit higher as well. Big exposure to the States. But Novo's quite soft, but a big move yesterday.
A big move yesterday. And speaking of a big move, the DAX, we're still waiting for the index to actually open and fully shake out. But yesterday dropped 1%. So I'm also curious how much of this green on the screen you're seeing in Europe is really a reaction to what you saw yesterday as well. Remember, we did see Europe sell yesterday. So there might be just simply a little bit of a shakeout. At least we're seeing that in the currency markets, where weakness was the story. This morning, it's strength. I'm curious if that shakes out in the equity markets as well.
Interesting to see banks doing well. Again, yesterday, banks were one of the sectors that did OK here in Europe. And
in the States.
And the States in particular, but even in Europe we saw that a little bit. And so we see that, maybe because rates stay higher for longer and that plays out better. Well, that's the US story. Anyway, there's a lot of moving parts, but banks seem to be resilient once again. Only two sectors in negative territory, so we are seeing a little bit of a bounce after yesterday's selling, perhaps.
We are, and we should mention Air France as well is also taking a big beating here. You are seeing their stock down about 11, 12%. It looks like their third quarter operating income miss is really taking a hit. That likely to show up as well. And I'm now hearing that we are getting the DAX open as well. And as expected, green on the screen there, higher by about 0.6% when we look at that index. The outperformer of the entire continent this morning. How much of that is a political story? How much of that is a positioning story? Let's ask a true expert. Jörg, head of European equity and derivative strategy over at BNP Paribas. Marcus 360 joins us around the table this morning. What is going on with the DAX? Is that a positioning or is it politics?
Yeah, good morning. Thank you for having me. I think if you take a step back and you look over the past year or two even, the DAX has a bit decoupled from the German economy and politics. And that's mainly because a lot of the constituents of the DAX, including SAP or Rheinmetall, generate a massive amount of their revenue outside of Germany. And hence the relationship between economic or political impact into the equity market is not as linear as it used to be. And I think that is exactly what's happening. If you look at SAP particularly, we were surprised of this move yesterday because, again, as Guy just mentioned, it has a large exposure to US. It is also fundamentally doing well, and the dollar revenue should have aided it. But because it is the largest constituent of SX5E and Europe, I think it has been taken with the wagon of selling into Europe from top-down investors. And we're just seeing a bit of a reversal of that trade today.
So you talk a little bit about how there is this kind of a divergence of the politics to the equity market, but is there a more clear line when it comes to the Trump trade? What is the Trump trade when it comes to the European equity market?
Yeah. I mean, I'm sure your listeners have listened to the Trump trade quite a lot over the past week or 2 weeks. And yesterday what we've seen was a clear Trump trade on override, if you want. You know, anything which is domestic into the US, small cap, more value type of sectors have performed quite well. Anything which is more like EU renewables or potentially at risk of trade tariff has been actually penalized. One thing that we saw yesterday, which was quite interesting, is we have this Trump baskets, obviously long versus short, winners versus loser. Many of our peers also have it. And since the open yesterday, it gapped 4 to 5%, and it's traded the whole day at 4 to 5%. It hasn't really moved, even though the market went -1, +1.5, then -1.5. Yeah. That spread stayed relatively quite flat throughout the day, which shows you that indeed, if you were on the right side of the trade with a long short, you would have fared quite well.
What about some of the European thematics that we've been playing of late, George? I'm thinking here about renewable energy, for example. I mean, Vestas was down on its numbers on Monday, was down yesterday substantially on the Trump trade, and that whole sector under pressure. It's down again today. Pretty flat, actually, relative to the last couple of days. But what visibility do we have around that sector?
We don't really have quite a lot of visibility, to be honest with you.
We have a lot of rhetoric and a lot of comment.
Exactly, we have a lot of comment. There's also, within the renewable is a bit of a new type of industry compared to the rest of the market, if you want. And it's also been a very finance-driven one, which requires low rates. And we haven't had that over the past 2 years, which also some legacy problems around the contracts has not helped the industry completely. But, you know, European companies and European governments are very committed to it. And so it's just about the timing.
A market starting to distinguish between European businesses that produce for America in America.
Correct.
And European businesses that produce for America elsewhere. Is this going to become... Because that will dictate where the tariffs fall, I suppose.
Correct, exactly. And I think that's one of the misconceptions that people have, is that they look at companies with a large share of revenue in the US and they think that these companies are going to be penalized. However, if you look, again, we divide our European market into 3 sectors, 3 parts. European domestic, European China, and European US, i.e. which has the largest share of revenue compared. And the best performer this year, even yesterday, are the European companies with a large share of revenue in the US. And the main reason behind it, as you rightly mentioned, is a lot of their cost production is local. And hence, there won't really be a tariff-based implication for these type of companies.
Can I ask the opposite kind of question? When do those other 2 baskets start to pick up? Because we must be nearing the point where, and I feel like I've maybe asked this question a few too many times over the last few years, we must be reaching the point where Europe is cheap enough, the news is bad enough, and you start to think that maybe actually, therefore, there is only upside from here. China potentially could stimulate in a much more substantial way with the Trump presidency. Europe may finally figure out how to get its act together. You may get some sort of a peace dividend out of Ukraine. You may get the ECB cutting more aggressively than the Fed. All of these things, you put them together in a basket, would seem to signal that there is the potential, finally, for some outperformance.
Music to my ears, to be honest with you. Which is a pitch that I've been trying to communicate to many investors for the exact reason.
Why aren't they buying?
Because sentiment remains lackluster, and because performance coming out of the US remains a lot more better than the one in Europe. And I just came back from a visit and roadshow in the US, and the narrative continues to be the same. US exceptionalism is here, growth is better, performance is better. And Europe, there is still a bit more domestic issues. Now we have also the German political issue that brings a bit more uncertainty. We're focusing on that.
But maybe clarity as well. But at least we get an early election.
Exactly.
And we start to move.
So I think Europe offers a very good contrarian long-term opportunity, but you need sentiment to turn, and you need us to get our ducks in places, which will take a bit more time. But as you rightly saw, we have all the right things that allows us to outperform. I think it's a 2025 story for now.
Are we still looking at some of the other asset classes as factors in the equity story? For example, the last time we had a Trump administration, the common trade was oil is a hedge, or oil is an inflationary, or oil is an input. We had the currency picture, the strong dollar being a continued component. Do we need to be paying attention to those other factors right now? Or is this kind of, are we returning more to maybe a FOMO moment or a valuation moment in terms of deciding whether or not you want to get into the stock market, either side of the Atlantic?
Yeah, so it's too soon to say, if I'm completely candid with it, but the reaction yesterday and also some of the investor calls that we've had shows that potentially now the main risk around the Trump trade is a rotation out of your winners and where it's over-concentrated. So over the past year, or let alone 3 years, we've seen that most investors are overweight the US, and within the US, they're very overweight big tech. And right now, the question that people ask, and some of the things, are we going to see a rotation into more domestic, small cap, and hence do we have a lot more legs to go there? And I think the answer is, if you look simply at positioning and how people have been so overweight the big tech versus the other, the answer is could be yes on that respect. But obviously, we need to watch all other risk assets, which have performed in line with what you would have expected, the textbook of Trump trade.
Right, that's nice. It sets up my question nicely. Talking of risk assets, is there also a risk that we see money going from those overweight big tech positions into crypto?
Correct.
Into crypto?
Into crypto.
I know that's not your universe, but it's
sorry.
a risk. But it's a risk to stocks, isn't it?
Yes.
This asset class that might get more political blessing, I suppose, and could tempt some of the retail crowd that maybe have piled into Nvidia.
Yes.
Into something like that.
It could be. It's not something that I could potentially comment on it, because I suspect within the world of asset manager and institutional, we're a lot more focused on the equity market and the conventional asset market. Retail could actually switch into crypto. I suspect they're also already quite big in crypto. So it's a question mark to be seen.
We'll park that one.
Yeah.
We will watch with interest. George, thank you very much indeed for dropping by.
Thank you.
George Abbas, Head of European Equity and Derivative Strategy, joining us from BNP Paribas Markets 360. Call 6 looks like this morning. Let's take a look at the centre of gravity in Europe. It's interesting to see that we do see a little bit of a tech coming back into bid, a tech bid coming back. So ASML a touch higher this morning, SAP as well. Maybe a bit of baby in bathwater yesterday being maybe one of the issues around there. But luxury's a little soft, which is interesting considering what we see in China. Schneider's a little soft as well. And Novo, look at that. Big move to the downside, but a big move upside yesterday. Let's talk about the single stocks in more detail. Joe's here.
So we got a big move in Air France shares this morning following their numbers. Now traders and analysts are pointing to increasing costs at the company, not just fuel, but also it is wages weighing on the outlook for their earnings. According to analysts, it looks like potentially some downgrades to consensus estimates will be coming for the flagship airline over in France, the flag carrier over there getting hit hard today. Then continuing in the aerospace theme, we have got a couple of earnings out today, as we mentioned earlier, from Defence. Rheinmetall potentially not getting as much of a boost as expected following their decent beat on their numbers. And Rolls-Royce actually declining. That stock is up massively, though, over the past couple of years, so potentially just kind of trimming at some of those gains in terms of their numbers. They did look pretty solid, but one of the best performers over the past few years in the UK on that one. Then over in the payment space, I think we're going to check in on another big move. This one actually halted in early trading. This is over in Amsterdam, seeing sharp indications lower on Adyen. It's the payment processing firm, and they have seen a big drop in some of their payment processing transaction volumes, according to their statements. So we're waiting to get a proper price on that, but traders were warning potentially double-digit declines in those stocks. Then the renewables. Remember, we've got a potential stake by Elliott in RWE, lifting that one, but the rest of the sector can't catch a break, really. Bank of America is today downgrading a couple of ratings. They've cut Vestas to underperform, and Siemens Energy comes down to neutral from buy. They are citing the new Trump presidency and potentially fewer contracts in terms of renewable energy projects in the US. So that sector really not catching a break after those massive declines. Remember, some of those stocks were down more than 10% yesterday. Then in terms of your UK earnings, BT, that one looked pretty steady to me, but actually slipping a bit. There's potentially some debt concerns at that one. Sainsbury's as well, maybe a bit of easing in the food prices hitting Sainsbury's today. And ITV, this one pretty clear. It is a sharp drop down in some of their ad revenue, according to the latest analyst comments on that one. So all of those UK earners actually declining in early trading today. Finally, the other one to bring you, Daimler Truck. Now, that one was actually lower on TradeGate, so potentially that one is not moving the way we expected. Maybe that was already priced in. The truck stocks had a bit of a rough run, given some declining orders, particularly in China, has hit that sector. So potentially just coming back up, maybe a bit of weakness yesterday on the Trump tariff concerns as well. But Daimler Truck holding up today, up 1% in Germany.
Joe, thank you very much. Joe Easton joining us there from our equities team. Lots of moving parts. I want to focus on the basic resources, just because we were mentioning this at the top of the programme. Had a very useful message from a viewer, which is brilliant. Do like it when people get in touch. Agreeing, Guy, that it has a China flavour to it, and specifically on the imports, drawing our attention to commodities imports. So even though the import story was weak, the commodities import story was pretty resilient, and that is the view coming through to me on the IB this morning. So thank you very much for that. And that seems to be supporting commodity prices, and as ever, that reads through in some of those mining stocks. Adyen shares halted in Amsterdam. The stock, it looks like it's retrading now, down circa 11%. The payment company, its stock has always been a little bit volatile, so we've had some big jumps in this stock over the years, and today looks like it is no exception. But I guess
fintech is a space that you would probably anticipate that probably would be what you would see. But the Q3 revenue certainly looks like it's missed estimates, and the market reacting in a fairly substantial fashion. So we're down by, let's call it 11% right now.
Yeah, it's going to be interesting. But when you look at the rest of the indices, though, green on the screen, it's a pretty broad rally when you look at some of these broader indexes as well. And I'm still kind of trying to figure out what we're pegging this to. What is the reaction? Because some of the pain is an individual stock pain. Airbus, for example, trading lower. Air France taking a little bit of a hit as well. These are all individual stock stories. But from a sentiment perspective, it feels like all clear.
Does it?
That's what I'm saying. I'm a little skeptical. What's going on?
Is it a little premature? It's a bit, maybe just a little bit of a turnaround from yesterday. I'm just diving into some of those individual movers that you were talking about. Swiss Re up by more than 6%. And this is obviously a fairly substantial business. They had numbers out earlier on today, and some of those seem to be going down well with the markets. US liability reserves increasing seems to be the headline that is moving the markets.
Yeah, that's the third biggest points gainer in terms of what we're seeing on the Stock 600 this morning. But SAP is up. It got thrown out pretty hard yesterday by the market in terms of its position relative to maybe some of its US peers. Shell is tracking a little bit higher. ASML's another obvious story. We've got the commodities story in there as well. Glencore, Total, Munich Re's maybe rising as well. But it's interesting to see all of that coming through. The stocks that actually moved more positively yesterday seem to be maybe seeing second-day selling.
Yeah.
So it's interesting to see that actually if you did well yesterday, you're doing badly today.
Yeah.
And the flip side of that, working on the more than positive side.
Can I just mention, we have a 1% difference between how the CAC and the DAX are trading. The DAX is higher by 0.9%, the CAC down about 0.1%. That is a massive divergence. I'm curious if it's going to show up in the bond market as well.
Yeah, we'll keep exploring that for sure. We did see early on in trading a little bit of divergence in the bond market story, very much at the edges, and we don't see much of it anymore, actually, just looking now. And they all seem to be yields moving a little bit higher in Europe. Maybe German yields a little more than the rest, but hardly anything in it. Coming up on the programme, we'll get back to some of the German story. The CEO of Commerzbank has told us that UniCredit's approach has been, quote, interesting. Not what you'd expect from a friendly approach, were the words of Bettina Orlop. We'll bring you more from my interview with the Commerzbank CEO. That's next. This is Bloomberg. Welcome back to the opening trade. 8:21 here in London. So we are a little way into the European bond market trade, certainly in continental Europe at least. And we do see those yields rising a little bit, certainly at the 10-year horizon. I'm looking at Germany up by 4 basis points, but others up by 2-3 basis points. So they're sort of in the mix, broadly speaking there. The UK moving in the other direction, but it has been going its own way of late, Guy.
Let's talk about what's happening with the shares of Air France this morning. Air France KLM down hard. The reason for it, it's not a revenue story necessarily. This is a cost story. It's a wage story, and it's also an older aircraft story. Remember, this is a company that had a revised wage deal that is now having to factor into its numbers. Increased maintenance costs. Why do you have increased maintenance costs? Because you can't get the newer aircraft that you want. Therefore, the older aircraft need more spare parts. Benedict Campbell, who leads our global aviation coverage, joining us now on this story. Benny, how big a problem is this? Is this something that's going to go away soon, or is this something that Ben Smith and his team are going to have to deal with for quite some time?
I think the latter is the case. They came out with their earnings this morning, and they said that in the third quarter costs were higher than they expected, and that in the fourth quarter that would continue to be the case. They revised their cost estimate, as you said. Previously it was a 2% increase, now it's 3%. You might think, 1 percentage point, that shouldn't be too much, but clearly markets are spooked by this. The stock down 12%, and it's the bigger picture really, as you alluded, that getting these aircraft into the maintenance shops, they have to be in more often, they're older, they are more expensive to service, and all these things are really rippling through the industry. We've talked about this many times, the Boeing issues, the Airbus issues. They're not getting, the airlines are not getting the planes, the new planes as quickly as they want, and therefore they have the older kit, and that's weighing on the costs.
OK, so that's the story, how it plays out for the customer. What about the supplier then, Benny? What do we know about Airbus and its ability or lack of to deliver the number of aircraft that it wants to?
Well, again, you know, this has been the story of Airbus. They're not in as bad a shape as Boeing, but it's not that great. We heard from Wizz this morning, for instance. They're a big Airbus customer, and they said that the engine issues are improving, but they're still here, and they don't expect to get out of it by until 2027. So that's some ways off, and it gives you an idea of just how pronounced the issue is. On Airbus, we had their monthly orders and deliveries this morning. That was a very closely watched number because we're creeping towards the end of the year, and they've said they want to do 770 aircraft in terms of deliveries, and that's really going to require a pretty substantial sprint. To get that goal, to get to that goal, they need to do more than 100 aircraft each month, and that's a lot more than they've done in each month so far this year. So not impossible, but it's going to be a real stretch.
All right, Bloomberg's global aviation lead, Benedict Kamel, walking us through both the Airbus and the Air France story. We thank you so much. Let's pivot to another sector we've got our eye on, and that, of course, is the chip story. Qualcomm and ARM have indicated a resurgence in demand for high-end smartphones, but their shares went in opposite directions on their differing outlook. Robert Lee from our Bloomberg Intelligence team is all over it. He joins us now. Robert, let's start with the ARM story. Disappointment there. What caused that when we're maybe getting different messages from different parts of the sector?
Yeah, okay. Well, first of all, context is everything. ARM trades on a very punchy multiple relative to the rest of the US tech sector, is the first thing I'd say. And it's also been one of the top performers. The share price has approximately doubled year to date. That's even outperformed the likes of Nvidia, which is only up around 30%. So there's a lot of expectation built into the share price. And second thing I'd say is you've got to understand where these two companies sit in the food chain. ARM doesn't make chips, it designs chips, which it then licenses to the likes of Qualcomm, to the likes of Nvidia, etc. So in years gone by, and speaking as someone who used to cover the company as a sell-side analyst, you know, back in the day in London, it's often seen as a bit of a canary in the coal mine. Now, I'm not saying in any way that is the case here, but the point I want to raise is its licensing revenue, because its chip customers will take licenses from it, as that they were then used to build and design their future chips. So we did see a little bit of weakness and some concerns on that side. And I think, again, when very high expectations are built in, that's one reason why the stock price did come off a bit. Qualcomm, on the other hand, strong numbers, strong guidance. It's actually benefiting from strong demand from the leading Chinese handset customers on the high end. And so, you know, a very different story on that front.
Robert, thank you very much. Robert Lee from Bloomberg Intelligence joining us there with a number of angles on the chip story. There's the ARM numbers, the Qualcomm story. I mean, big picture, though, I think there's a lot of fascination with what Trump plans to do when it comes to AI, when it comes to chips and domestic production in the United States. That might sound like something he'd like, but some of the comments from his team suggest that maybe he has more complicated views on that.
What happens to the IRA? What happens to the CHIPS Act? What happens with that kind of funding that the Biden administration has delivered could be really interesting, but a lower regulatory bar could be fascinating as well. Maybe more M&A potentially on the table as well.
We should mention, though, that, of course, the executive branch has no control over the judicial system as well by design, but it is certainly something that is a bipartisan issue. We've already seen it in some of the big tech names as well. So a lot to digest. I imagine the interest rate environment will have a big effect on the kind of sweetening of the deal of M&A, the pricing, and, of course, the appetite as well. Coming up, we're going to go into that story, but right here in Europe. We're going to break the Riksbank decision, the start of a big day for central banks. Stick with us. This is Bloomberg. Welcome back to the opening trade. We are, of course, getting headlines in the central bank story. Let's kick it off with the Riksbank. Sweden's central bank cutting the policy rate to 2.75%, cutting it by, as expected, 50 basis points. Now, this is important here because this is a very easing environment specifically for the Riksbank, but it also is, of course, being compared quite aggressively to the Norges Bank. We are expecting that decision in just 30 minutes' time. That outlook looking very different. Immediately, the currency impact you want to see is very limited, actually, and a lot of that simply because it was expected, Anna, ahead of this decision that this would be the story.
Yeah, and they're giving a bit of guidance, saying that they may also cut in December and in the first half of 2025. So if we're looking for signs of global central banks saying Trump's going to be inflationary, we're not going to do as much cutting as we would have done if he were not in the White House, we're not necessarily seeing that yet. We might get that, but not maybe today.
But is this also an indication maybe just of this big divergence that could start to exist
European on its own
on either side of the Atlantic? The ECB has to do more, despite what is happening maybe with the tariff narrative, which could, as you say, be inflationary. inflationary. So I don't know. Maybe this is just an indication. Very clear. I wonder whether it's almost too early, though, for us to be reading into this the Trump story. And maybe that's also maybe evidenced in the BOE a little bit later on.
Yeah, well, let's see, of course, what the BOE has to say, because they are also expected to cut interest rates yet again by another quarter point. Uncertainty ahead seems to be the common theme. Bloomberg's UK correspondent Lizzie Burden standing outside the Bank of England. Lizzie, set us up for today's decision.
Well, Kriti, amid all that uncertainty, I do not expect the Bank of England is going to want to surprise the market today. All the economists in our survey expect a quarter-point cut, the second in the cycle from Threadneedle Street. But the focus, as you say, very much on the path ahead. You've got to also factor in Chancellor Rachel Reeves's budget, the biggest fiscal loosening in decades, hence that gilt market reaction last week, which, by the way, has wiped out any headroom she had and therefore makes more tax rises likely in the future. But because it's such a fiscal loosening, you saw traders paring their bets on BOE rate cuts ahead. But then, as you say, there's also the factor of Donald Trump's win. Tariffs could weigh on European growth, perhaps to a lesser extent here in the UK. But then you've got JP Morgan Asset Management's Karen Ward saying if there's a fiscal response, that could be inflationary. So it'd be really interesting to hear from Governor Andrew Bailey at the press conference later what his view is. It's too late for them to factor in the election into the updated forecast, but you could see the budget meaning an upgrade to growth and inflation. We're really going to see whether Andrew Bailey sticks to these hints about more aggressive policy ahead when we hear from him later.
Lots to think about then here in London on the Bank of England. Thank you, Lizzie. Bloomberg's UK correspondent, Lizzie Burden. And for viewers in the UK, we will have special coverage of that decision and the press conference. That starts at 12:30 p.m. London time. You can follow that on TV. And, of course, you can use the function Live Go on the Bloomberg terminal. Now, let us move on. Donald Trump's election is also having an effect on emerging market currencies, could give their central bank something to think about. Let's get details from Bloomberg's Valerie Teitel. Valerie.
Anna, it was quite a day for all EM markets, but there was a few different narratives I want to pull out. The first one, let's start with the Chinese yuan. A lot of people expected to see weakening on a Trump win when it comes to the Chinese yuan, but it was quite substantial yesterday. It was the worst session for dollar CNH in 5 years. It weakened 1.5% versus the dollar. A lot of that to do with the tariff story from the U.S. on China. Let's flip the board, though, and talk about another currency that we thought would move to the downside because of tariffs, but it actually didn't. It was the Mexican peso. At one point during the session yesterday, it had weakened nearly 3.5%, but that all snapped back because of a different narrative here, Anna. It was more of the fact that the market was really trading this pro-growth, pro-U.S., U.S. exceptionalism trade, and Mexico is a high beta play to U.S. growth. So it was a bit of revaluation on the Mexican peso yesterday afternoon and actually ended the session flat. When it comes to the expectation for growth, though, there was a very different view when it came to Central and Eastern Europe. I want to talk about dollar huff for a second. The Hungarian forint hit the lowest level in 2 years versus the euro, and it weakened versus the dollar as well. Now, this trade is all because CEMEA, or Central Eastern Europe specifically, is a leverage play on European growth. And as we saw in the trade yesterday, there was a lot of a dour mood when it came to the move lower in euro and the move lower in euro stocks on the hit to growth that these Trump tariffs could entail and their effect then again on Central and Eastern Europe.
Valerie, thank you. Lots to think about. Bloomberg's Valerie Teitel. Let's stick with the emerging market currencies theme. Bring in Phoenix Kalin, a global head of emerging markets research at Societe Generale Corporate and Investment Banking. Phoenix, nice to have you with us this morning. So, big picture, if we sort of zoom out from here, it seems that emerging markets are going to be dealing with this idea that on the one hand, they probably quite like a US growth story that's strong if that lifts, you know, if that rising tide lifts all boats. But on the other hand, they don't want it to penalise them and to be at their detriment and to damage their currencies. How do you approach the emerging market story through that sort of big picture lens?
Yeah, so I think there are two components to this. One is that directional move in terms of the U.S. growth now being stronger, lower taxes, lower regulations, higher deficits. That's going to really gear up and leverage up the amount of growth we might see out of the U.S. and consumption and patterns and so on. And that is going to have a beneficial spillover impact into LATAM economies, into a lot of the European and Asian economies as well. So I think that's quite beneficial for emerging markets. On the other hand, we've got this relative value kind of dynamic where the U.S. is, again, going to be quite the exceptional story out of the whole world basket, and that's going to be quite a high differentiator versus other countries to look at, and that sets a really high hurdle rate for emerging markets. So for investors to think about investing in EM where there is more risk, more geopolitics, more volatility, it sets a much higher threshold. So I think there's that component to consider. But I think we are likely to see some positive underpinnings come out of the Trump victory, and especially out of the whole kind of red sweep, where the policies are going to be much more aligned and implementable. And in that case, perhaps there might be some upside to things around like geopolitics, for instance. If we have maybe a situation where there's upside tail risk for resolution around some of the conflicts, Russia, Ukraine, Middle East. Yeah.
So there's a lot in the mix. Still waiting for news on the House as well, aren't we? So, we're looking like the sweep is still incoming.
Yes, but increasingly looking like it is a sweep.
Yeah.
Clearly, we saw central banks stepping in yesterday. I think you probably saw that in India. You probably saw that in a few other places as well. What action do you think central banks in, for instance, Central and Eastern Europe might now take? Should we be thinking about, with the Hungarian forint at 2-year low, should we be thinking about rate hikes? Should we be thinking about rate hikes in other parts of Central and Eastern Europe? We seem to be talking a lot about cuts elsewhere around the world, but are there areas within the emerging market space where hikes are now back as a real probability?
Yes, for sure. So in Hungary, for instance, they are considering emergency rate hikes if HUF continues to depreciate at this pace, and we are reaching 2-year lows already, and they are quite cautious about that kind of sensitivity of the economy to the currency depreciation. So it's a possibility that we might see emergency rate hikes out of HUF if there is further depreciation there. In Poland, we saw flat rates yesterday. In Czech, we're expecting for them to cut 25 basis points later today. So they're moving quite cautiously. I think HUF is the one who is the most sensitive, and it's got the highest beta to dollar moves. So that's why there is so much sensitivity there. Plus, it's a smaller market, less liquid. So I think there is concern around whether or not that weakness in HUF can be extended. And yes, the possibility for emergency rate hikes is back on the table. And in Brazil as well, we saw that 50 basis hike. We're expecting for further hikes over the coming months. So they are definitely concerned about the external environment and the de-anchoring of inflation expectations.
Phoenix, how attractive is the carry trade right now in this environment, specifically when it comes to the peso versus the yen, where you're looking at potential hikes from the BOJ and weakness off trade and off the dollar in the peso? How attractive is the carry trade?
The carry trade overall is really not attractive. I mean, if we're looking at all of emerging markets, the annual carry that you get from EM is less than 1% versus the dollar. So it's very unsubstantial as a buffer that you have to protect against currency weakness. So it's not a compelling argument as it used to be in years past. And I think when it comes down to it, it's more about the underlying fundamental dynamics that you're looking at, growth differentials, the idiosyncratic stories that come out of these markets. It's much less about carry.
OK. Let's linger in the Eastern European space for a moment, because we spoke to a guest pre the election who was saying, these are the types of economies that do get hit because they're small, to your point about one of them at least, and open. And that's where I think his focus was on Poland. How do you distinguish between them and where you see the opportunities in Eastern Europe at the moment?
So we do think that Hungary and Poland are the most sensitive to the dollar moves, to the treasury moves as well. They've got the highest betas to U.S. treasuries and to the DXY, between 1.2 and 1.8. So very highly leveraged to kind of those dollar moves. And they will be vulnerable. Poland less so because it's a much bigger economy, much more diversified in terms of its exports and manufacturing and services sectors. Hungary, much more concentrated in terms of its reliance on exports. So it's going to be hit much harder in terms of those feed-through from the European economies into Hungary.
Can I just talk about the relationship between Central and Eastern Europe and the ECB? I've just seen a Deutsche Bank note dropping into my inbox this morning. We're lowering our central case terminal rate forecast from 225 to 150 at the ECB. There's a 75 bip terminal rate drop that the Deutsche Bank sees for the ECB. If the ECB starts to aggressively cut rates from here and do it a little bit more quickly than maybe anticipated, how does that spill over into the rest of Central and Eastern Europe?
if that does happen, and that's not our base case scenario, then that does give the CEE central banks more leeway to cut rates without fearing that they are going to damage their currency unnecessarily. So that gives them more scope to be able to accommodate their economies. But that's not what we're anticipating. We think that the ECB is going to be quite careful. Our analysis around tariffs is that is not going to impinge too much on growth. Or on the inflation profile. And the ECB is going to be quite reluctant to act ahead of time preemptively. They want to see kind of the materialization of these impacts and what it actually means over the medium term before engaging in kind of decisive decisions.
Before it starts having an impact, you would have thought maybe some of the economic data may encourage them to be a bit more careful in terms of the rate story. Phoenix, nice to see you. Thank you very much indeed for stopping by. Felix Kellan, Global Head of Emerging Market Research at SocGen Corporate Investment Banking. Thank you very much. What else have we got coming up? We're going to turn to that German political story. The German Chancellor Olaf Scholz naming his new finance minister after firing Christian Lindner from the FDP. And it looks like we're going to see a snap election, probably at the beginning, or certainly over the next few months. Actually, I feel this morning that the dates are shifting around a little bit. Anyway, we'll get more on that story in just a moment. This is Bloomberg. 45 minutes past the hour. Crude really choppy yesterday. Today a little bit softer, as you can see. Brent to TI both just giving back a little bit in the early session. In theory, Donald Trump should mean more oil. Is that actually the reality? How does the oil market deal with Trump 2.0? Let's find out. Nadia Martin-Wiggen, Director of Svelland Capital, joining us now. Drill, baby, drill, Nadia. Is that what we should be thinking about over the next 4 years?
Well, Trump did talk about oil and gas being America's liquid gold yesterday in his victory speech. Although we already hit record U.S. oil production in August under the Biden administration. So in practice, it shouldn't mean that much of a difference. But yes, he will be promoting more oil and gas developments.
It changes to governance in Alaska and the ability to get oil out of that particular. Is that the area of focus, Nadia?
Yes, that is a part of it. Also, in terms of costs, you know, the Biden administration and the expectations for Kamala were that they would be focused more on, you know, the environmental impacts, you know, things like flaring, methane leakage, things like that. You know, there had to be more pipelines installed to have takeaway capacity for natural gas in order to promote growth in the Permian Basin on the supply side and things like that. So I think that's also an element that can potentially bring down costs for oil and gas producers in the coming years under a Trump administration.
Nadia, I want to zero in on that, and you kind of hinted to it there, but there were certain projects that the Biden administration was aggressive on and really kind of got a lot of flack for, and the likes of federal kind of fracking in New Mexico in terms of the pipeline in New York as well. Do those problems go away under Trump?
Well, I think the focus go away is maybe overstating it, but I think the focus will absolutely be on producing more and rebuilding and accelerating America's competitive advantage as the world's largest oil and gas producer, bringing down costs for local producers and also building up exports of both oil and gas. So they will definitely try to cut red tape and make it quicker.
So, Nadia, about 2 years ago, 2 years and counting, when the war in Ukraine first broke out and Europe suddenly needed a lot more of LNG supply, the issue in the United States was that the infrastructure to get it from some of the kind of sources to the actual ports didn't exist. Where are we on that? Does that infrastructure now exist?
Yeah, the U.S. has made big inroads in terms of building out infrastructure versus where we are in 2022, where we were in 2022. But there are bigger ambitions, and this is where, you know, Golden Pass, Plaquemines, those are two big LNG terminals that are being built. They're still not complete and fully running. That will be happening over the next year. And more importantly, when we think about that medium-term relationship with Europe, to have Europe not depend on Russian natural gas, which is something that Trump very blatantly pointed out in a NATO meeting. The way to secure that is through American supply. That's how we keep Europe away from Russian gas. And so we believe there will be accelerations on building that out, especially towards 2027, 28, 29, and past 2030.
Nadia, let's talk a little bit about what's happening with the offshore wind industry. Vestas is down, on my chart, 22% over the last 3 days in terms of its share price. Some of that's its numbers, some of that is the reaction to Trump. Are we going to see less metal in the water in the United States as a result of a Trump presidency?
Well, our view at Svelland Capital is that offshore wind is not a proven business case and strong model. So I think that is the number one driver as to why things look tough. Trump has made it no secret that he's not a huge fan of wind. He tends to prefer solar. But still, overall, it is a problem, I think, first and foremost on the business case. And that's where renewable power that is successful and is making money and is doing very well, that is the part that should really grow going forward. And part of the reaction yesterday, we think, was unmerited in terms of the negativity towards some renewables because of this focus on fossil fuels. We need to recognize that we are short energy in general. So we need to develop both renewables and fossil fuels together and not make it one or the other kind of debate.
Yes, and I'm really fascinated to see what policies are enacted around EVs with Elon Musk also making regular visits to the White House. Nadia, thank you very much. Nadia Martin-Wiggen, Director at Svelland Capital, thank you very much for your perspective on commodity markets. Let's turn our attention to developments in Germany. Fast-moving story last night and into this morning. Chancellor Olaf Scholz's economic advisor, Jörg Kukies, is now going to become the finance minister. He replaces Christian Lindner, who was fired quite dramatically last night. This after Scholz called for a snap election after divisions over how to revive the lacklustre economy triggered the breakup of his fractious three-party ruling coalition. Let's bring in Bloomberg's Europe executive editor, Chad Thomas. He's in Berlin. Chad, update us on the timing of all of this, because last night we were hearing Olaf Scholz has called for an election to take, or a vote of confidence, rather, to take place in January. Others in the German political scene are saying that's not soon enough and calling for it to be earlier. What's the latest that we know about the timing?
Yeah, and we were talking about this an hour ago, and I was saying to you then that things were moving quickly. In that hour since we last spoke, we've had the German opposition leader, Friedrich Merz. He is the head of the Christian Democrats. That's the party of Angela Merkel. He came out and said that he wants this to move much more quickly. He's asking for a confidence vote in the government to happen as soon, or actually as late as next week. If it would happen sooner, even better, in his opinion. And that he wants to see that snap election come in January. Why is this important? Because Olaf Scholz now has a minority government. He needs support from people in the opposition if he's going to continue on, even for a short period of time, until they have that snap vote. Friedrich Merz says he will meet with Olaf Scholz this afternoon to discuss all of this. But given the fact that he's now pushing, Merz is pushing for this snap election to happen much more quickly, we likely will see things developing rather quickly in the next couple of weeks.
Chad, what are the polling, if you believe it, is your choice, but what is the current polling actually telling us about who could form the next government were there to be an election tomorrow?
Yeah, the polling at the moment, Guy, is showing that Friedrich Merz would be the next chancellor, which, of course, is one reason why he's saying this should move quickly. His party, the Christian Democrats, are at about 30% in the polls. They're way ahead of others. All of the parties in the current government, Scholz's Social Democrats, the Greens, and the pro-business FDP, they have all really struggled in the polls. They're way below where they came in the election 3 years ago. And so it is likely that whenever these snap votes happen, we're likely going to have a Chancellor Merz, whom he will end up in coalition with. Hard to say. Obviously, if you have 30% of the vote, that's not enough to form a coalition on your own. So we will have, again, a coalition government in Germany.
And it'll be interesting to see what kind of spending decisions are made. Bloomberg's Europe executive editor, Chad Thomas, joining us. Kriti, alluding there to what could come next, and also potentially the unleashing of a bit of German fiscal space that you could see on your chart next to you.
Yeah, it's really interesting here, and I think it's important for our global audience to just kind of understand just how much of the wiggle room, as Scholz puts, actually exists. And this is why they can have that conversation in a way that maybe France, the United States, and other economies around the world cannot in terms of their debt story. It's the debt-to-GDP ratios that matter. This bottom line in blue is the German debt-to-GDP ratio, including the projections from the IMF going all the way out to 2029. You can see how it's actually on a lower curve right now. It's actually standing at a 62% by 2029, expected to drop by 58%. The stark difference with this versus what we're seeing in France could not be bigger. That spread in the debt-to-GDP ratio could not be bigger. And this is the conversation that's been happening in that Oat to Boon story that we've been talking about for a good chunk of this year. Let's talk a little bit about how the German bond market is trading right now, because you are actually seeing something that is very rare, and that is bear steepening. That matters simply because this is something you don't see in Germany. That curve, that bear steepening, is usually associated with an expectation of a rise in inflation. You are not seeing that at the moment. The last chart I want to bring up to you has a lot to do with the idea of swaps. We're getting a little nerdy here. Shout out to our producer, Valerie Teitel, for making this. But it's the expectation of that increased issuance that's starting to show up. When you see that Bund yield actually getting higher, you really have to narrow in here. But take my word for it, the Bund yield is now higher than the 10-year swap. Do we get that more issuance, or is this just a little bit of saber rattling?
It's going to be fascinating to watch and could have a really big impact in terms of the European story on where money gets spent. This is obviously going to be something that I suspect that everybody's going to be talking about at the EPC meeting, which is taking place in Budapest today. We're seeing arrivals happening right now. Here's a live shot of the football stadium where that meeting is taking place. It is a huge day coming up, though. We're not really into the story yet. We've got the Bank of England coming up. We've got the Fed coming up a little bit later on. Both, I suspect, are going to see some sort of a Trump influence, particularly the Fed.
Right, yes. Is it too early for it to be an official forecasts and official thinking? But certainly it'll be there in the questioning, won't it? Just how inflationary is a Trump presidency going to be? And, of course, that will be part of the Fed conversation and, no doubt, also influencing the Bank of England conversation. And we've already had rate cuts from the Riksbank, so we're kind of as you were previously planning on the central bank story. So maybe it is too soon, but that's certainly in everybody's minds.
But maybe this is where the commentary matters more than the actual rate decision and the forecast itself here. The cable's still at a 129. I'm waiting for that to crack if this is the kind of notice that we're getting from the BOE.
Do we get that cracking a little bit later on? We're going to have some special coverage coming up of our of the Bank of England. Lizzie Burton's been out there all morning. Remember that we get the decision at noon. We get the 12:30 press conference. We will bring that to you live here in the UK with some special coverage coming up a little bit later on. You can also use the function Live Go for that. This is Bloomberg.